Good morning, everyone. Thank you for taking the time to join us this morning as I present our 2021 interim results. During today's presentation, I'll be sharing with you how Spear has navigated the last 6 months to the end of August 2020. Before I kick off this morning's presentation, I would like to extend a word of appreciation to all the healthcare and frontline workers that have tirelessly worked to curb the spread of COVID-19. I would also like to recognize the incredible role our staff have played achieving the interim results. Familiar themes will come through in this presentation from our pre-close presentation held at the end of August 2020. South Africa now finds itself at alert level 1, with the vast majority of economic activity having returned, albeit under severely poor economic conditions. One of the points that I'd like to make right at the start of the presentation is that Spear has managed to navigate these very tough times due to its management's hands-on philosophy and regional focus. This has allowed us to focus our time and our resources without distraction solely on the Western Cape. The lessons learnt and experience gained during the last 6 months will undoubtedly be of benefit to Spear in the years to come, as stronger tenant relations have been forged and reinforced during this time. In our pre-closed presentation, I set out the operating context Spear finds itself in, which has been consistent with the majority of our peers during this period. The operating context in the 6 months to the end of August 2020 has been extremely difficult, with rent relief, cash flow relief, rental credits, and deferments needing to be activated as measures to protect and assist the general tenant base from the economic fallout of the various forms of lockdown. Having been part of the team that navigated the past 6 months, I'm extremely proud to present the results of a great team effort. I will say it again, the results we have achieved are as much about our people as what they are about our high-quality asset base. Thank you to all our staff for their significant sacrifices and commitment during these very difficult times. On behalf of the executive team, I would like to extend a word of thanks to our chairman, Mr. Abu Varachia, and our board of directors for their ongoing guidance, support, and financial sacrifices made over the last 6 months. Please make some notes during the presentation, as we will be having a question and answer session afterwards. We look forward to hearing from you. Any questions that you may have during the presentation, please email them to info@spearprop.co.za. Just having a look at what I'm going to be covering over the next hour or so in the presentation. Moving on to our environmental update. The trading environment within the Western Cape, and South Africa for that matter, remains very tough. But we are seeing an uptick in business activity across the board. The depth of disposable income remains uncertain. However, convenience retail activity, industrial manufacturing, and logistics seems to have gained the most traction over the reporting period within our portfolio. We are seeing clear return to work strategies being implemented by many office users across the Spear portfolio, as digital fatigue sets in and productivity levels become more and more difficult to measure. One of the best measurement tools for the return to work activity is the level of traffic flow into the various office nodes across the metro, which have noticeably increased, along with parking bay occupancies in various office buildings across Cape Town. Unfortunately, the tourism, hospitality and services sector will have to wait a little longer to see improved recovery, as the government released very disappointing travel regulations banning many countries that would ordinarily be feeder markets to South Africa from entering the country in a bid to stem the spread of COVID-19. We have noted with some relief the list of prohibited countries has now been reduced by government, and government is further committed to updating this list every 2 weeks. These decisions have pushed us to be even more entrepreneurial in our approach to our hospitality assets, with various calls to action campaigns being launched to attract business and revenue. A special mention must be made to our hotel asset manager, Mr. Franz Stein, and his superb team. Your relentless pursuit of revenue and making provision to save staff jobs has been a privilege to witness. And on behalf of this entire group of directors, I wish to say thank you. During the interim period, the lion's share of the portfolio has remained resilient, underscoring the deep value proposition that the Spear portfolio offers shareholders and investors as high-quality assets, high occupancy rates, and consistent contractual income provides income certainty during these uncertain times. As mentioned in our pre-close presentation, having a 100% regional focus has allowed us to focus all our energy and attention on speedily finalizing various forms of relief to impacted tenants. Those tenants most impacted outside of the hospitality portfolio were those in the travel, tourism, restaurant, and entertainment sectors. Management notes that the latter has resulted in a marginal increase in portfolio vacancies. However, I'm extremely proud to announce a over 90% tenant retention rate across the portfolio. Spear remains an authentic dividend-paying income fund focused on consistently operating with a strong balance sheet and delivering on our mission statement, which is our North Star. And that is to be the leading Western Cape-focused REIT and to consistently grow our distribution per share ahead of inflation within the top quartile of our peer group. Now, as a firm believer that the art of navigation is best learned before entering the storm, Spear's consistent, active asset management and hands-on real estate management approach over the years has best possible prepared us for the current trading environment. At the onset of the pandemic, management had to speedily develop and initiate mitigation measures to ensure business continuity through the implementation of immediate, short-term COVID-19 operating strategies. I'm extremely proud as to how Spear has fared in this regard. In May 2020, we set out to the market our short-term strategy on navigating through the pandemic. How have we done? We have successfully adjusted to a COVID-19 operating environment. Sufficient capital has been preserved and management continues to manage liquidity. Income statement consistency has been maintained with strong rental collections for the interim period under the circumstances. A focused and strong drive to finalise renewals and new lets has resulted in very successful letting activity on a year-to-date basis. We've maintained high tenant retention rates as well as our landlord of choice status. Debtors management has been sound with a notable and ongoing receivables reduction from our pre-close presentation. Group-wide expenditure has been reduced with reductions in payroll, fee reductions, and other controllable expenditure. We continue to dispose of non-core assets in line with our LTV reduction roadmap, which I will set out further on in the presentation. Moving from the short term, looking towards the medium and long term, we maintain our aspirations of becoming a meaningful mid-size REIT with assets under ownership of roughly 15 billion within the Western Cape. There is no race for us to get to that number. We will do so conservatively and on a value investment approach. Spear will remain a regionally focused REIT that annually endeavours to reward its shareholders with a mission statement aligned return on their investment within our company. We will narrow our asset ownership to commercial, convenience retail, and high quality industrial investments with a clear focus on fixed income as opposed to variable income investments. We will maintain our distribution payout ratio policy of between 80 and 90% of funds from operations. We will continue to weave renewable energy solutions into the fabric of our business and investment approach. We will prudently recycle capital through earmarked disposals. We will reduce our gearing ratio in line with our strategy to between 38 and 43% over the next 18 to 24 months. We will maintain our conservative debt hedging profile with an internal ceiling of 75%. We always strive to maintain high portfolio occupancy levels with strong cash flows and strong lease covenants. And we'll continue to fully comply with the South African REIT legislation. Having a look now at the impact of COVID-19 on Spear. Spear, as a Western Cape-only investor, has continued to carefully navigate through these very fluid and tough trading environment. The residual impact of the pandemic and the related lockdowns will continue to impact this business in varying degrees in the months and years ahead. Investment decisions and strategic objectives in the short term are continuously reassessed through the lens of the last 6 months and how best to approach the journey ahead. As a management team, our primary focus has been on rent preservation, tenant retention, tenant support, debtors management, and vacancy management. Daily and active asset management takes place across our business to ensure business and revenue continuity. During the pre-close presentation, I set out our best possible view of what percentage of our tenants based on revenue per rentable area could trade under the government's risk-adjusted lockdown approach within their physical premises. Over the last few months, government has permitted more and more economic activity to return than initially allowed under various lockdown levels. We now find ourselves under alert level 1, with 100% of our tenants being able to legally operate from their respective premises across the portfolio. As you can see, the amended regulations have had a positive impact on Spear and its tenants, with the full portfolio being operational from the 8th of September 2020. During the May presentation, we further set out various operating scenarios as we were entering the start of the pandemic in South Africa. I feel it's important for me to recap on those operating scenarios. These scenarios set out Spear's various income positions through the collection percentages and what demands it may place on the business going forward and coming through the pandemic. We set out a low road which was collecting 60% of our original budget would allow Spear to break even, cover all its operating expenditure and finance costs. We had a mid-road scenario where we collect between 61 and 71% of our original budget, which would mean Spear would be moving towards profitability and accumulation of cash reserves. Then we set out a high road scenario, which is collecting 80% and upwards of our original budgeted revenue. This would make Spear profitable and on track to stabilized net operating income generation. What does the status quo look like? The trading environment remains incredibly challenging, but we cannot deny that some positive strategic objectives are being achieved during this time. 86% of our total budgeted rentals have been collected during the interim period. Bearing in mind, just to be clear, this budget was set in December 2019, assumed no pandemic, and furthermore assumed income as per normal on our hospitality assets. Spear is profitable and operating consistently in the high road scenario operating scenario set out in May 2020. The balance sheet and income statement remain robust and meeting all covenants. Liquidity availability has remained sufficient to absorb various rental credits, deferrals, in addition to covering all operating costs and interest. There remains a zero going concern risk across the business. Zero funders assistance has been required during this time, and none will be required into the foreseeable future. Spear's funders remain aligned and in support of Spear's strategies. Spear remains sufficiently capitalized to meet all its short and long-term commitments. Spear's 2021 renewal and relet program has been excellent. Lockdown alert level 1 restrictions have been disappointing, and the hope is that fewer countries are restricted from entering South Africa, especially those that we rely on for our feeder markets into the hospitality sector. The DoubleTree by Hilton has hosted over 600 people since reopening. Group meetings, conferences, accommodation, and food and beverage events have been on a consistent increased trajectory. We have seen group meetings go from groups of 10 people, 20 people, to 30 to 45 people meeting since it was allowed to open under the government regulations. Both the DoubleTree by Hilton and 15 on Orange Hotel have been fully operational since the 8th of September. When considering all these issues, we have successfully navigated through this pandemic. All the points I mentioned above, I believe to be extremely positive. So having a look at our interim salient details. Spear owns 32 high-quality Western Cape assets with a portfolio value of 4.46 billion rand. During the period, asset value growth has increased by 6.54%, with our average property valuation increasing from 129 million to 138 million per property. The average property valuation is 9,753 rand a square meter. As I mentioned in the past, the replacement costs for a diversified portfolio such as Spear's would be significantly higher. The portfolio continues to present substantial value to our investors, as the valuation is a direct correlation to our portfolio not being over-rented and our conservative valuation approach. I do look at the segmented valuations in more detail further on in the presentation. Our average in-force escalation, 7.25%. Escalation rates have come under consistent pressure as both inflation and interest rates have been on a declining cycle. Our negotiations teams strive to achieve the best lease escalation rates. However, we strive never to lose a deal or a tenant over an escalation rate. A prolonged vacancy is a lot more expensive. Our portfolio GLA at August 2020 was 453,016 square meters, increasing by just on 17,000 square meters since year end as a result of the Liberty Life acquisition in Century City. Our portfolio tenant retention rate at August 2020 was 91.2%. This is due to Spear's tenant-centric approach coupled with our early engagement strategy. A high tenant retention rate has been part and parcel of Spear since inception, as we see and approach our tenants as shareholders in our business and as us being shareholders in their business. This creates a common purpose, resulting in the longevity of the business relationship. Our weighted average lease expiry is 28 months. Management makes a concerted effort to push out the WALE as far as possible. However, under the circumstances, tenants have a reluctance to commit for a longer period of time, as the operating environment remains to a degree uncertain and very fluid. We remain nimble and offer various forms of lease tenure flexibility options. However, I must note that also in the interim period, we've seen tenants signing for between 7 and 10 years lease agreements. Our focus has been, as I mentioned, on preservation of our income in the short, medium, and long term. Thus, flexibility has to be given in certain instances. An internal target of 36 to 45-month WALE has been set by the management team, and we are all working towards this goal. Our average portfolio rental, 89 Rand and 33 cents per square meter gross. This again brings me back to the value proposition I mentioned in the average valuation per square meter earlier. Generally, our rentals are either on market or just below general market rentals, making it both attractive for our tenants to remain within our portfolio and equally more difficult for existing tenants to relocate to other properties. Testament of the latter can be seen later on in the presentation in the excellent progress made by our letting and property management team on a year-to-date basis under the letting activity and renewals. Most importantly, our interim collections have been 96.1% of our revenue build, being nothing short of excellent. And we have maintained a very focused approach to our collections and problem solving during this interim period. On a year-to-date basis, our collections are at 93.8% of revenue build. The measurement date of that was 15 October 2020, so after the interim period. Collections remain strong as more and more tenants return to more and more meaningful economic activity. Having a look at our interim collections versus our original budget set in December 2019, we have recovered 86.13%, and on a year-to-date basis, 83.72% compared to original budget. Just moving on to our financial performance. Looking back on how this financial year started and the various levels of lockdown that followed, I was concerned for the general well-being of our business and our nation. This all being said, I'm extremely proud to announce a 29.34 cents distribution per share for the interim period. The interim distribution amount of 29.34 cents is based upon a revised payout ratio of 80%, with the balance of retained income post any taxation being deployed into strengthening Spear's balance sheet. Spear's SA REIT cost-to-income ratio for the interim period was 39.14%, which is higher than normal due to the BPR requiring a gross disclosure. In addition to limited to no hospitality income for the interim period, short-term increased cost to adapt to the COVID-19 operating environment, which includes various forms of cash flow relief, deferments, credits, bad debt provisions, write-offs, and various health and safety costs. Spear's SA REIT administration cost-to-income ratio was at 5.65%, which is a reduction from the 5.71% at prior year end. Aggressive cost-cutting and payroll sacrifices were made during the interim period to strengthen the cash position of the business and to push the business towards operating in the mid to high road scenario plan. Our tangible net asset value is R11.75 per share pre-distribution, which is a 0.98% increase in tangible net asset value compared to the prior interim period, but a 3.45% decrease from the end of the prior financial year. I'll give more context to the TNAV during the TNAV bridge slide. Our TNAV net of distribution is R11.46 per share. Our LTV, the portfolio LTV at the interim period is 45.36% post all interim period fair value adjustments having been made. Portfolio devaluations of R81.2 million were passed at the end of the interim period, being a 1.81% decrease in portfolio valuations. We do not see any further significant asset devaluations coming through for the balance of the FY21 year. The assets were valued using a 5-year DCF model, and as a result of the difficult prevailing conditions, all valuation parameters used in the property valuations have been reviewed and adjusted where necessary. I'll provide further details on the valuations and methodology further on in the presentation. Spear's fixed debt ratio, 69.90%. This is on the upper end of our internal range, with an internal limit of 75% of our debt being hedged at any given time across the debt portfolio. Our average debt expiry is 26 months, with no refinancing risk, and in excess of R1.13 billion worth of debt facilities renewed and extended during the interim period. Spear's average cost of debt was 7.56%. Our average cost of variable debt, which isn't in the slide, but I'd like to note it, is 5.67%, noting that 30.1% of our group debt is variable, creating some tailwinds in interest cost savings during the period, with a 275 basis point interest rate cut by the Reserve Bank during the interim period, saving approximately R6 million on finance costs. Spear's average cost of fixed debt was 8.72%. Moving on to the slide that probably interests most on this presentation this morning. The table in the slide itemizes our various collections over the interim period, together with the post-interim period guidance into collections beyond August 2020. Our year-to-date collections under the circumstances have been satisfactory and in line with management's high road scenario plan. For the avoidance of any doubt, billings reflect all credits and deferments inclusive of recoveries, but excluding VAT. Original budget reflects pre-COVID operating revenue, including hotels, and recoveries set in December 2019. Zero hospitality income is recorded in the billings recovered, but factored into the various scenario plans. Tenant arrears at the end of the interim period amounted to R13.5 million, decreasing by R2.6 million from R16.1 million reported in the pre-close investor update. At last measurement date, being the 15th of October 2020, arrears for the interim period decreased by 5.4 million to 8.1 million per the table below. Spear's proactive, in the trenches and non-bureaucratic response has resulted in our ability to report the strong year-to-date rental collection figures and percentages. For the interim period, as mentioned earlier, 96.90% of gross rentals billed have been recovered. On a year-to-date basis, 94.03% of gross rentals billed have been recovered. Having a look at our exclusions, credits, and deferrals. A direct result of the COVID-19 pandemic, management has restructured, renegotiated, or provided relief to 196 of our 442 tenants. A notable slowdown has been seen in tenant relief requests, as a majority of tenants are permitted back at work as economic activity has recommenced. The table below sets out to you the impact financially of the COVID-19 pandemic on Spear. Per our May 2020 results presentation, zero income has been forecast for hospitality, having a negative 12.3 million rand impact. We provided credits to the amount of 11.6 million rand, deferrals of 6.6 million rand. However, I'd like to note that of that 6.6 million rand, 1.3 million rand has already been recovered. We've stopped billing tenants to the value of 1.9 million rand, which excludes any portfolio vacancies. We do not anticipate that number to increase beyond 2.4 million rand for the full financial year. We have, however, had some tailwinds with the solar roof rental payment coming in to the period as they completed our solar rollout on a portion of our portfolio with a positive impact of 4.4 million rand. So having a look at our interim financial performance. One of the hallmarks of our business, being a SA-only focused fund, is a clean and easy to understand income statement. Spear has no cross-currency interest rate swaps and also has no exposure to foreign exchange movements. As I said before, the furthest offshore we'll go is Robben Island. Our group revenue for the period was 254 million rand, which includes our lease smoothing, with a total group expense of 89 million rand, which is our property and management operating expenditure. Administration costs were held very tight at 13.2 million rand. We've had some non-cash deductions, which are the fair value adjustments coming through the income statement, some depreciation, and the IFRS 2 adjustment for our CSP expenses. Our net finance cost for the period was 69.9 million rand, the net result being a 29.34 cents distribution per share based upon an 80% payout ratio. The 2021 interim distribution per share is 34.26% below from the prior reporting interim period. This decline is not a like-for-like decline, given that Spear's payout ratio has been adjusted to 80% of funds from operation. In the prior period, 100% of funds from operation was declared for distribution purposes. The decline in the interim distribution per share is directly attributed to the COVID-19 operating environment, giving rise to zero hospitality revenue, the need for rental credits and deferments, and lease structures, in addition to tenant failures in certain parts of the portfolio, as discussed earlier. Our interest cover ratio, which is our income before tax over our interest bill, is 2.17 times, exceeding our funder's covenant of 2 times. It's worth mentioning that the ICR for the interim period was mostly impacted, as you know, through a lack of revenue from hospitality, deferrals and credits. However, as economic activity starts to return, the interest cover ratio for Spear is on the improvement path. Having a look at our like-for-like stats, on a gross basis, we have seen a 3.74% decline in like-for-like income. On a net property operating profit basis, we've seen a 5.79% like-for-like decline compared to the prior year. On our property operating and management expenses, we've seen a 2.72% decline from the prior year as a result of a management-imposed austerity measures to reduce group break-even during the interim period. Having a look at our reconciliation between earnings and distributable earnings, we have a SA REIT funds from operation of 67 million rand. We have an add back of 6.1 million rand IFRS 2 expense, with a company funds from operation of 73.2 million. We adjust that for the 80% payout ratio, which gives us a 58.5 million rand interim distribution, being a 29.34 cents per share distribution. Moving on to our balance sheet, total assets under ownership, 4.5 billion rand, with total liabilities of 2.1 billion rand. As you can see, from the bulk of our property debt is non-current at just over 1.6 billion rand, and current liabilities just on 504 million rand, consisting mostly of 4 property facilities, which we're in the process of reducing as part of our, or settling as part of our Spear LTV reduction roadmap. I will discuss the debt portfolio in more detail in the coming slides. Spear has just over 205 million shares in issue and 199.6 million shares net of any treasury shares held by the company. As mentioned, the LTV at 45.3%. This is on the upper band of management's LTV strategy. However, through our earmarked asset disposal strategy that we've put in place, the LTV strategy over the next 18 to 24 months is to reduce to 38 to 43%. And again, our TNAV, net of distribution, was 11 Rand 46 cents. So having a look at our TNAV bridge, at the end of the Feb 2020 year, 12 Rand 17 cents per share, deducting the FY20 distribution of 47 cents, fair value adjustments of 41 cents, a couple of adjustments for treasury corrections, IFRS 2 expense gives us a 11 Rand 75 cents tangible net asset value, less our distribution, gives us an SA REIT NAV at August 2020 of 11 Rand 46 cents. Moving on to our funding, a special mention of appreciation to our funders Nedbank CIB and Standard Bank Real Estate Finance. Your ongoing support and alignment with Spear is greatly appreciated. We continue to enjoy an excellent working relationship with our funders and look forward to many more successful years ahead. During the interim period, post-year-end, Spear's average cost of funding has declined by 119 basis points to an all-in 7.56%. Our CFO, Mr. Christian Barnard, has done a great job getting our debt portfolio costs down to the levels that they are. What is further noted is that 70% of our portfolio is hedged, and Spear's average cost of debt is only 56 basis points above prime. Our total net debt, 2.09 billion. As mentioned earlier, our fixed debt of 1.46 billion is at 8.72% with a maturity period of 22 months, and 30.1% of our variable debt, 629 million, at 5.67% with a maturity period of 25 months. Having a look at our debt maturity schedule, we have a 26-month average debt maturity profile. There's zero refinancing risk across the debt portfolio. Spear has a robust and well-spread expiry profile. Our strategy is that the FY21 debt of 67 million, in addition to some FY22 debt, will be settled in due course. Moving on to our LTV forecast to year end, as can be seen on the slide, we closed the interim period with a 45.36% LTV post fair value adjustments made on portfolio assets. Historically, as a management team, we have been comfortable operating in the mid-40% LTV range, given the conservative valuation of the underlying portfolio. Since the onset of COVID-19 pandemic, the performance of real estate assets possibly with the exception of potential of e-commerce focused logistics and self-storage, have been suboptimal, impacting rental income prospects and in turn asset valuations in some instances. As a management team, we have opted for a proactive approach in establishing an LTV reduction roadmap. Spear continues to meet all its LTV and ICR covenants, with no concern that either covenant risks being breached in the foreseeable future. The implementation of this roadmap will be the start of a journey to operate within a 38 to 43% LTV range in the future. The roadmap is illustrated in this slide as follows. We've concluded some disposals, there's some development activity within the portfolio, and then there's the interim distribution. We have a disposal, 12 Pickwick, which will have a 36 basis point reduction to our LTV. This property is disposed at a value of 30 million, which is at book value. A second disposal, as announced on SENS, 15 on Orange sectional title scheme, will cause a 354 basis point reduction to our LTV, which was disposed at a 1% premium to our book value. The third disposal is 142 Edward Street, which will have a 56 basis point reduction to our LTV, which is disposed of at 42 million rand, which is just on book value. Then we have two development projects, which organically improve the quality of the portfolio off the back of both 10-year lease agreements, will be the redevelopment of our One Beacon Way facility. This has been let to Grindrod Logistics, which I'll talk to further on in the presentation on the development projects. We also have the interim distribution, where Spear will be offering a dividend reinvestment program, and the assumption has been made that between 50 and 70% of shareholders will elect the DRIP option as opposed to receiving the cash dividend. With our establishment of the LTV reduction roadmap, a successful DRIP will act as one of the balance sheet strengthening tools at our disposal, together with the successful asset disposals as noted above. Why do we believe our roadmap is sound? So here are some of the reasons we believe so. We currently have 368 million rands worth of disposals underway. Management has set an 18 to 24 month achievable roadmap in place. Disposal yields range from between 9 to 10%, which provides investors with a decent spread between debt funding rates and the asset yield. Two of the three non-core disposals are full cash deals with no funding requirements. We've received notable interest on Spear's hospitality assets. As noted, a full cash offer of 280 million rand on 15 on Orange, which is only subject to a due diligence and Competition Commission approval. We note that our disposals are within a pricing segment that is attractive to all types of investors, and we've noted strong investor interest in the price points of the earmarked disposals, which could allow us to identify some of the other non-core assets within the portfolio to dispose of in the fullness of time. The low interest rate environment has created a larger pool of investors to participate in the 30 to 90 million rand price point market. All our disposals are in relative terms priced fairly, located in popular nodes with good covenants and high quality tenants. All the assets are in the Western Cape, which in my opinion is the best localized investment region in South Africa. All proceeds from the disposal program will be deployed into Spear's debt facility, starting with the most expensive debt. Moving on to the portfolio overview. Having a look at our top 5 assets. Our top 5 assets are truly iconic investment assets within the Western Cape and South Africa. The cumulative GLA of our top 5 assets equals 177,000 square meters, making up 46% of our total portfolio GLA and 45.5% of our total portfolio value, being around 2.03 billion rand. 3 of our top 5 assets are valued in excess of 400 million, and 2 of our top 5 assets valued in excess of 300 million. This really talks to our less is more approach, where we choose to own fewer properties, but instead own properties of higher values. The latter allows us to have a focused asset and property management strategy per property, and to really remain hands-on and close to our tenants. Our top 5 assets also display very good portfolio diversification, with every one of these assets located in very sought-after Cape Town investment nodes with strong demand and sustainable income growth. Another value proposition of this portfolio, as you can see, are the valuations per square meters of these assets. All top 5 assets are valued well below replacement cost. It again indicates a conservative valuation process that's been undertaken, and the assets asking rentals are not over market. Having a look at our split by value, revenue and GLA, our total property value, 4.46 billion, of which 48% of the value is made up of commercial, 26% of industrial, 15% of retail, 10% of hospitality, and 1% of development land. On a revenue basis, excluding smoothing, 241 million generated, 48% of revenue from commercial, 34% of revenue from industrial, 16% from retail, and 2% from hospitality. On a GLA basis, 30% of the portfolio is commercial, 54% of the portfolio is industrial, 10% of the portfolio is retail, and 6% of the portfolio is hospitality. Moving on to our letting activity. The below table reflects the letting activity for the interim period. A total of 130,000 square meters became due for renewal and relet in the FY21 financial year. With at interim period, 101,125 square meters had either been renewed or relet. We can see the positive commercial rental reversion is due to number 1 Waterhouse being let at 30% above its rental guarantee amount, which expired in June 2020. Retail reversions have been negative, but this was as a result of 2 retail tenants and was in line with management's expectations. I do believe that Spear's hands-on asset management strategy, our early engagement strategy, and our tenant-centric approach continues to bear fruit as we have incredible momentum in the letting activity for this financial year. Looking at our tenant and vacancy profile, our total vacancy at interim period was 39,920 square meters, which was just under 9%, which is by far the highest vacancy rate that we have ever had. But bearing in mind that 16,170 square meters of that vacancy has been let and is currently under redevelopment for Grindrod Logistics. Post that, the vacancy rate will drop to approximately 5.4%. Spear has 442 tenants across its portfolio, of which 30% make up A-grade tenants, large nationals and international tenants, 54% national tenants and smaller listed companies, 8% make up entrepreneurial businesses, owner-occupier businesses and other, with a portfolio vacancy at interim end of just on 9%. Having a look at our lease expiry profile, we are very comfortable as a management team with the lease expiry profile, as a roughly 18% of the portfolio comes up for renewal and relet annually. Moving on to our valuations. A lot has been said on the topic of property valuations on a year-to-date basis, as the impact of COVID-19 swept across the real estate landscape. As a responsible manager of our assets, the management team undertook property valuations at interim period with due consideration to the impact of COVID-19 and the impact of the associated lockdowns on Spear and our tenants. As one has seen in our collections, Spear has maintained its collections successfully under the circumstances and have been able to maintain the various income streams across the diversified portfolio with the exclusion of hospitality assets. As a business and management team, we pride ourselves in the level of transparency and disclosures provided to the market. Each property has been analysed in terms of its quality, location, strength of covenant, and lease term, taking into account the COVID-19 operating environment. A conservative approach was adopted to the valuations through the increase in our capitalisation rates between 0.25 and 0.75%. The average exit capitalization rate increased by 0.59%, with our industrial portfolio increasing by 0.63%, commercial by 0.57%, and retail by 0.58%. Further prudent adjustments were made, which were 2 to 4 months average vacancy void period provided, 0.5% to 2% of income, structural vacancy, and bad debt contingencies provided. This giving us a portfolio devaluation of 81.2 million rand, as disclosed earlier. Some further noteworthy points that I would like to make. 54% of our portfolio are industrial assets, which has proven to be resilient with consistent cash flow generation. Spear's retail investments make up 10% of GLA and are convenience focused. The majority of our tenants have been able to operate from level 5 lockdown right down to level 1. Spear's commercial assets make up 30% of GLA, and certain commercial assets have seen an increase in value as a result of strong contractual rental generation, as well as in certain instances very successful letting uptake in the case of 100 Fairway Close and number 1 Waterhouse, as earlier discussed in the letting activity slide. All our assets are located in sought-after locations with rentals that are not grossly over market, resulting in a high tenant retention rate and sustainable cash flow generation for Spear. There are some key assumptions and unobservable inputs that we've used in determining the fair value, which I'm happy to take you through in this following slide. When looking at the diversified portfolio, you'll see that our industrial portfolio on an average valuation per square meter is valued at 4,692 Rand per square meter. Our commercial portfolio valued at 15,497 Rand a square meter. Our retail portfolio valued at 15,592 Rand a square meter, and our hospitality portfolio at 16,263 Rand a square meter. All of these properties and assets are valued at well below replacement cost. The subsectors of the portfolio are comparable with our peers, and in some instances, as mentioned, below the median peer review, in addition to being valued at below replacement cost. The current portfolio valuation symbolizes fair value and has taken into account the various adjustments and provisions that we've had to make under the current trading environment. So moving on to our sustainability update. Significant progress has been made in the execution of Spear's sustainability strategy as our management team, as we focused on energy and water resource management across the portfolio. As a responsible corporate citizen, Spear's focus is to place less and less reliance on fossil fuel generated electrical supply and to limit the usage of clean potable water in areas not required within the business. Management, through its PV solar strategy, has successfully initiated and completed PV solar solutions for 6 out of 16 properties, with a balance set for completion towards the first quarter of 2022. Approximately 4 million kilowatt hours of solar energy will be generated over the next 12 months on the 6 completed sites, with anticipated savings of 4 million Rand at current tariffs. 5 new sites will begin construction within 4 to 6 weeks of lockdown having been lifted, adding a further 1,300 kilowatt hour peak of solar to the real estate portfolio, and a further 2 million kilowatt hour peak of solar energy. The average penetration rate will be between 25 and 30%. Just talking about water continuity and resource management continues across the real estate portfolio, with water augmentation and purification systems installed across the commercial office portfolio in the form of reverse osmosis water purification systems for clean potable water and grey water systems for ablutions. This will reduce our overall reliance and usage of clean water. Bulk water storage facilities are linked into operational boreholes and well points across the portfolio. We further note, as part of our corporate social investment, we have, under Radnor Road, donated our roof to as a CSI initiative, which funds the bursary of a previously disadvantaged female through the Women's Property Network Educational Trust. This is our way of utilizing our assets to empower not only the business, but to also empower those that are previously disadvantaged. Having a look at our sectoral performance, our retail portfolio consists of just under 45,000 square meters. Retail portfolio occupancy is at 91.65%. Collections have been 88.32% versus revenue billed for the period. SPIA has provided credits and deferments to the retail tenants to the following values: 4.2 million rands worth of credits and R500,000 rands worth of deferments. May to August, credits and deferments have reduced significantly due to tenants being able to reopen under level 4 onwards. During all levels of lockdown, our retail tenants have performed in line with expectations, with all anchor tenants operating under level 5 lockdown onwards. Letting activity has continued and continued to be in line with our expectation. There hasn't been significant retail tenant failures during the interim period. SPIA has, however, elected not to raise rental on gyms, of which there are 2 within the portfolio. However, I'm pleased to report that since September 2020, our gyms are again paying us rental. Trading conditions on the ground have improved, with positive tenant feedback which underscores our view that open-air centres would trade better than closed centres over the next 12 months, as residual effects of the pandemic work through the system. SPIA has no exposure to Edcon or Massmart within the retail portfolio. Again, just having a look at the risks, we believe that there are lower levels of income risk as 100% of tenants are now trading and paying their rental. Gyms will take longer to recover to pre-lockdown levels and would require longer-term lease restructuring and assistance. There will be pressure on consumer spending as South Africa navigates itself through a recession, which potentially could impact the convenience retail sector and tenants' ability to honour all of their rental obligations. Having a look at the commercial portfolio, 137,285 square meters. I'd like to reiterate this again, that working from home is not a one-size-fits-all solution. Thus, office space in good areas will remain relevant, but landlords will have to think about the overall experience of coming into the office and how that can be more attractive. An increase in the return to work plans have been noted in the Cape Town office market, with digital fatigue setting in and productivity levels dropping. All SPIA's commercial assets are located in highly attractive and established office nodes in Cape Town. Our occupancy rate is 91.07%. Collections have been 95.70% versus revenue billed for the period. SPIA has provided credits and deferments to office tenants in the form of 3.5 million of credits and 3.1 million of deferments. Again, May to August credits deferments have reduced significantly due to tenants reopening under level 4 onwards. SPIA's portfolio is attractively positioned to offer expansion and or contraction space to tenants due to its attractive lease terms and generally below market asking rentals. In certain parts of the portfolio, tenants have needed to increase their premises to comply with COVID-19 social distancing requirements. In other parts of the portfolio, headwinds have emerged as knee-jerk reactions to cut overheads led to non-renewal of certain office premises within the portfolio. The impact of load shedding has caused tenants to rethink their decisions to just work from home. This is a fact. Load shedding will remain part of South Africa's narrative for at least the next year or two. All SPIA's office locations are fitted with robust business continuity solutions in the form of power backup generators. Again, what do we see as the risks? Asking rentals are set to soften as vacancies may rise higher than normal. Increased vacancies would result in increased competition for tenants, and generally the potential is higher for negative rental reversions across the office sector. The cost of installation of tenants will be expensive as landlords will be forced to offer more and more incentives. Having a look at our industrial portfolio, making up 243,158 square meters of GLA, SPIA's industrial portfolio has been exceptionally resilient during the interim period, with a number of new lets and relets taking place in a very challenging market. The industrial portfolio occupancy, taking into account the 16,000 under development, was 90%. This will have a 6.5% impact on the industrial vacancy once completed. Collections have been 96.25% versus revenue build. Spear has provided credits and deferments to industrial tenants to the following values: 2.5 million rands worth of credits and 2.6 million of deferments. Again, we've seen a significant reduction of credits and deferments since May to August 2020 as a result of increased tenant activity. The vast majority of Spear's industrial tenants were able to operate from level 4 onwards. Just noting the risks, load shedding may have a negative impact on manufacturing tenants. There may be labour relations and trade union challenges. There will be increased capital requirements to maintain the quality of industrial assets. And there may be market failure in certain instances to specific sectors or tenant failures. Having a look at our hospitality portfolio, making up 27,606 square meters of GLA. This sector has been by far the hardest hit by the COVID-19 pandemic. As a result, management had eliminated hospitality income from its FY21 forecasts. Compared to the prior year, hospitality made up 7% of group revenue. Having a look at the Doubletree by Hilton in Cape Town, we generated 2.5 million rands worth of revenue during lockdown level 4 through repatriation services. And again, it's testament to our management team not resting on our laurels, going out there to find business in tough times. This is what you as shareholders will always be assured of. We prepared and distributed 50,000 meals to the needy and homeless in Woodstock, Salt River and Cape Town CBD. And again, I would like to extend a word of thanks to the parties and shareholders that generously contributed to this initiative. Since the 1st of August 2020, corporate travel accommodation and conference bookings have been permitted, and we continue to receive these bookings as we move on. Post aggressive cost cutting, the hotel break-even is achieved at 48% occupancy. We are currently about 27% away from break-even. Our best possible forecasted operating summary on occupancies: November 2020, 22%, unless additional feeder markets are allowed into the country. December 2020, 44%. January 2021, 30%. And February, 55%. One thing that we have done, and we've done well, is we've focused on the local market and tapping into the local leisure and business market to increase revenue on this property. Average room rate forecast to be between 860 and 1,050 Rand per room. Rooms sold forecasted to be approximately 11,000 rooms during the period November 2020 and Feb 21. Bookings are coming in, but lead times are shorter. So we do maintain our conservative recovery approach for the rest of the FY21 year. Having a look at 15 on Orange. To be clear, 15 on Orange Hotel is under lease to Marriott International, which reopened on the 8th of September 2020. Spear has zero exposure to the 15 on Orange hotel property related expenses. Spear accrues rental on hotel revenue generated on the property. Marriott remains responsible for all sales and marketing of the hotel, with numerous accommodation and conference inquiries already being received for the periods November 2020 onwards. For disclosure purposes, we've generated 104,000 rands worth of rental for September 2020 from 15 on Orange and expect to generate a further 100,000 Rand estimated for October, noting that all of the above potential revenue is unbudgeted on the income side. Looking at the risks, which in this sector seem to be many, the business travel market is going to recover slowly, but the good news is that it is recovering. The meetings, incentives, conferences, and exhibitions market may be a little bit more reluctant to meet in larger groups, but as I mentioned at the start of this presentation, those groups have become larger and larger. There may be some geopolitical risks that increase, and as always, Within South Africa, given the operating context, there may be certain safety and security concerns. Having a look at general business continuity risks across all sectors, it's notable that tenants' cost of occupancy is on the rise and does rise ahead of inflation. Any new government restrictions that may limit tenant operations, major market or tenant failure, civil disobedience and property-related threats, and a second wave of infections across the world and in South Africa. So having a look at our development and redevelopment projects, as mentioned, we have successfully concluded a 10-year lease agreement with Grindrod Logistics for the redevelopment of 1 Beacon Way. The redevelopment cost of 44.4 million rand at a targeted yield of 9.04%. This is set for completion between February and March 2021. We have furthermore entered into a long-term lease renewal with Nampak Limited. In addition to that, to the renewal, an extension of the existing facility, which will increase to 14,500 square meters of warehouse facility. That will be done at a redevelopment cost of 34 million rand and a targeted yield of 9.33%. This is expected to be completed in December 2021 as a result of their specific operational requirements. Then we have our ambitious project in Pardon Island called Marine Place. I'm pleased to advise that we've received our finalized rezoning and we are now in a position to actively plan but not yet implement the development of this scheme. The GLA to be developed will be 52,000 square meters. It'll be a mixed-use facility of 12,000 square meters of convenience retail, 10,000 square meters of premium offices, and around 600 to 700 high-quality residential units. Moving on to our outlook and our prospects. Management remains heavily invested in Spear with around 34% of shares in issued, displaying our ongoing alignment and commitment to our shareholders. The macroeconomic conditions will remain very difficult to navigate. The recessionary environment may possibly impact income and growth opportunities over the balance of FY21 and FY22. The core portfolio remains of high quality and defensive in nature, positioning Spear favorably to continue its successful navigation of the current trading environment. Travel restrictions will impact Spear's tourism, and the general services and hospitality sector, prolonging the recovery. Commercial office vacancies may trend upwards in the short term, with office users uptake normalizing in the medium term. With the exception of a second wave of COVID infections, significant market or tenant failure, or another government-imposed lockdown, management is confident that cash flow generation will be maintained for the balance of the FY21 year. Management will remain client-centric and focus on sustainable cash flows as lease renewals and filling of vacant space remains a top priority. All the necessary health and safety measures have and will continue to be implemented across the portfolio. Management anticipates that rental recovery collections will continue and will be maintained within the high road scenario. Earmarked assets will be actively and successfully disposed of in line with management's LTV reduction strategy. Our Western Cape focus will be maintained and our proximity to our assets will remain excellent. So having a look at our guidance, it remains difficult to fully predict the economic outcomes of the pandemic on the real estate sector and on Spear, as South Africa navigates its way through the aftermath of the COVID-19 pandemic. In short term, we don't expect any significant macroeconomic improvements, making the journey ahead more cumbersome. We do, however, wish to provide the following guidance. Spear will remain fully compliant with all the qualifying requirements of a JSE-listed REIT and will continue to be a distribution-paying operation. As mentioned in the presentation, Spear's payout ratio will reduce to 80% of funds from operation in the interim period, and we will advise of any changes to the payout ratio for its final distribution for FY21. As a prudent measure, management has still not provided for any income from its hospitality portfolio for FY21, irrespective of low levels of revenue being generated post the interim period. These revenue levels remain variable and inconsistent at this stage. Spear continues to meet all its covenants and remains sufficiently capitalized. Regular cash flow analysis is performed to stress test the cash flow on a rolling 12-month basis. This includes a range of scenarios of tenant collections and creditor requirements. Management's focus and energy remains on rental preservation throughout the pandemic, lockdown, and beyond. Management will provide a further trading update and guidance on the final distribution per share declaration in a pre-close presentation prior to year end. Spear will exit its hospitality assets in an orderly manner over the next 12 to 24 months. In closing, we start closing off the 2020 year. For so many of us, this year has been incredibly challenging and life-changing. It's been a year like no other. We've been entertained by a variety of light-hearted memes to help us cope. We've made the odd batch of pineapple beer. We've been deprived of the Rugby Championship and the Olympics, and humorously told 1,000,001 times, "You're on mute." Similar to our fellow men and women, I've experienced phases of discomfort during this chaotic time. It remains an honor and a privilege for me to lead the team at Spear, and we reaffirm our commitment to you. I wish to thank you for joining us today, and we'll be joining you shortly for a question and answer session. God bless. Welcome back. Thank you for joining us for the presentation. We'll now be following that on with the question and answer session. I'm joined here by our CFO, Mr. Christian Barnard, and we have asked our Chief Investment Officer, Kim Pfaff-Karg, to ask the questions.
Thanks, Quintin. The first question is from Titanium Capital. Good day. Thank you for the presentation. On slide 33, hospitality, you provide guidance on occupancy for DoubleTree being 22% for November, 44% for December, 30% for January, and 35% for February. There is talk of a pickup in staycations with South Africans travelling more locally. In this context, the occupancy levels seem low. Could you provide some detail as to the reason for this?
Thank you. As we've seen, and as I mentioned in the presentation, general lead times when it comes to reservations are exceptionally short. So what we do is we do take a very conservative approach on our forecasts. So we are able to say these percentages are generally what we see as business on the books for the period. However, we have no doubt that as we navigate closer and closer to those specific months, that we will see an uptake. As an example, we saw in the month of October, we had business on the books at the DoubleTree of about 300,000 Rand. We'll be closing off the month of October with concluded revenue of close on 1 million Rand. So we have actively engaged with that staycation market, which is a localized travel market that we are looking to bring into our hotels over the festive season. And we do believe that, yes, albeit slightly low, it's more of a conservative forecast, and we do expect to exceed that forecast over the period.
Thank you. The second question is from Umtambu Wealth. Should you not have some impairments on assets considering this economic environment and your exposure to hospitality? Christian.
Good afternoon, everyone. We did have some impairments on our assets. We did disclose the impairments on a slide as well in the booklet in a specific section regarding the metrics we used. Everything from exit cap rates to void periods, vacancy periods, we did disclose all of that. In total, it came to about 81.2 million. The reason for that being, as Quintin discussed in the presentation, was we did have some positive valuations from assets coming out of development, assets where we've actually got positive rental reversions, which actually resulted in upwards valuations, as well as the Liberty Life building, which we acquired at a very attractive yield, and there was some cost savings in that property, which resulted in an increase in valuation. Then regarding hospitality, we did not decrease the valuation on 15 Orange because of the offer that we did receive. That is actually slightly above our book value, so we decided to leave the valuation as is, and we will look at it as during the progress of it. Upper East Side, we did have formal discussions with various offers that we received, as Quintin mentioned in the presentation, and we did devalue this asset for 3 consecutive reporting periods. And at this point in time, we find it more prudent to wait for more clearer income streams and evidence going forward, and then externally valuing the property at the end of the financial year.
Thank you.
We have a question from Pete Prestorius. I totally agree with your longer-term narrowed focus on commercial, convenience retail, and industrial. Do I read in this statement that hospitality is regarded as non-core and that you plan to exit hospitality in total, Christian?
The assets are not considered non-core, but as Quintin mentioned in his prospects and forecast, that we do intend to exit hospitality the next 12 to 24 months in an orderly fashion, so that we will definitely not consider it as non-core in the future, but we consider offers that is acceptable to us in the future.
Thank you. We have a couple of questions from Marzi Capital. The first one, can you provide me with more detail on potential disposal of 15 on Orange Hotel? The yield, provision of rental guarantee, and the buy.
Yeah, I think we always operate with high levels of transparency, and hence the issuance of the SENS announcement. We would prefer to advise the market in a more detailed announcement at an appropriate time what those metrics are. But indicatively, disposal yield was in the range of between 8 and 9% range. We have got a rental guarantee provision, which effectively is an underpin provision in the agreement, which does have moving metrics, depends on certain levels of performance during the due diligence period. And other than that, it's basically in the interest, given the fact that we would have professionals doing the due diligence on site during this period, we felt it prudent to issue that SENS announcement. More details than that, unfortunately, I can't disclose to you at this point in time, as we are equally keen to conclude this transaction, and we want to ensure that the purchaser has the opportunity to conduct its due diligence in the appropriate manner.
Another question, Quintin. Do you have any other disposals on the cards?
I think we have in the disposal slide, we did note the 12 Pickwick property, the 142 Edward property, and 15 on Orange. One property that, and also number 8 Section Street, which is in Pardon Island. As I mentioned in many other presentations, that within our business, there is no holy cow. If we are approached by a potential purchaser, whether it is our largest asset, whether it's the second largest asset, if the price is right and we feel that we have created enough value for shareholders, we would take it to our investment committee, we present a case, and then it's up to the investment committee, who are made up of predominantly non-executive directors, to make a decision based upon a recommendation by the executive team.
Will the fund have to take a material reversion on retail leases in order to maintain a decent level of rental cash flow? What sort of leases are being negotiated? Turnover-based, term of lease, break clauses, etc.
Yeah, so in terms of our retail portfolio has continued to trade very strongly. Spear has only ever invested into convenience retail assets. On a valuation basis, our retail portfolio is valued at just over 15,000 Rand a square meter, with our average retail rental being just under 150 Rand a square meter, which is very, very attractive in this current trading environment. Retail vacancies that had occurred during the interim period, in fact, at Sable Square, we had about a 700 square meter vacancy, as you would recall from the prior pre-close presentation, which has been re-let in excess of the rental paid by the outgoing retail tenants. So we believe that A, our portfolio is valued fairly, B, our rentals are either on market or just below market, making it very attractive for potential retail tenants, and C, they are located in very attractive nodes that offer easy access for parking, open air shopping centres, and a very attractive tenant mix.
Final question from Marzi Capital for Christian. Given your higher LTV, has the fund requested covenant waivers from banks?
We've not specifically requested the covenant waivers. We've had discussions with our funders if it would be needed. There's been talks, and the general consensus from our funders is that if any breach is due to COVID-19, it will be discussion regarding a condonement or a temporary movement. But luckily at this point in time, we have not needed to have those discussions. We've made the information available to them, and they know exactly where we stand. And at the moment, we believe they are comfortable with the information and the scenario, and we are comfortable where we're operating.
Thank you. And the final question we have is from Green Star Holdings. When do you anticipate the Beacon Way and Nampak developments to be completed? Christian or Quintin?
I'll take it. Beacon Way, we anticipate to be complete by the end of March, and occupation in April. And then for the Nampak development, or just the extension to the warehouse, we will anticipate that will be complete in the June-July 21 financial period. 22 financial period being 2021.
Thank you very much.
Any more questions? Ladies and gentlemen, thank you very much for joining us today. Again, the trading environment remains very tough, but be assured that our proactive and entrepreneurial approach to our assets will ensure that A, we comply with income statement consistency, we meet all of our covenants, there is no threat of covenant breaches across the portfolio from a funder's perspective, and we continue to operate within the high road rental collection scenario. Thank you very much for joining us today.
Thank you very much.